We are told that buying life insurance is a cornerstone of responsible adulthood. But what if that expensive policy you are paying for isn't the safety net you believe it is? What if it's a financial anchor designed to sink your savings? This isn't a takedown of all life insurance. It's about one specific type that millions are sold, one that can sabotage your financial goals. We are going to break down the three biggest red flags and show you what to do instead. The first red flag is the high cost of whole life, endowment, or ULIP policies. Agents pitch them as 2 for 1 deal, a death benefit plus a savings account. But these bundled policies can cost 5 to 15 times more than a simple term policy for the same death benefit. And the fund value they praise, it grows painfully slow because a huge slice of your premium goes to high fees and the agent's commission, not your savings. The guaranteed growth rate often fails to even beat inflation, meaning your money is losing value. And any non-guaranteed bonuses rarely make up for the high cost and lack of control. The second myth is that you need life insurance forever. The real purpose of insurance is to replace your income for those who depend on you, like your young kids or a spouse paying off a home loan. But that dependency doesn't last forever. The goal is to become self-insured. Once your kids are independent, the mortgage is paid, and you have built your own savings, you don't need to pay for a safety net anymore. Your own assets become your protection. So, what's a smart move? It's a strategy called buy a term and invest the difference. Instead of overpaying for a complex policy, you buy a cheap term policy that covers you only for the years you need it, say 20 or 30 years. Then you invest the difference, thousands you are saving on premium for yourself in things like mutual fund SIPs. This keeps your insurance and investments separate, putting you in control of your financial growth. You have the potential to grow your wealth far faster than the insurance company's low returns. The goal isn't to pay for insurance forever, it's to build enough wealth so you don't need it. If a light bulb just went off, do this after the video. Get a quick quote for a 20-year term policy online. Then compare it to a quote for an endowment or ULIP plan. The price difference will shock you. And if you are finding this useful, hit subscribe so you don't miss out on more financial secrets. So let's recap. Avoid expensive complex policies because of their higher cost and poor returns. Remember that insurance is for season, not for life. The smartest path is to buy affordable term coverage for when you need it and invest the savings to build your own wealth. Don't let a sales pitch lock you into a product that profits the seller more than you. By separating insurance from investment, you protect your family without hurting your financial growth. You know the secret the industry hopes you won't. So the next move is yours.